Hi, this is Krishna Makharia, CFA, Executive Director and Head of Research with iVentures Capital. इस वीडियो को लास्ट तक देखिए क्योंकि मैं 5 रेशियोज तो आपको बता ही रहा हूँ. उसके अलावा I have a small bonus measure for you which will help you in selecting your fund manager. Before we start this video, I want to give a small disclaimer that this video is purely for educational purposes and is not an investment advice. For your portfolio selection, always hire a coach or an advisor who can help you select mutual funds and securities. मैंने तो 15% बनाया जी. Most often we hear the statements like this कि we made double digit return, we made higher returns, but don't you think it is baseless? हम जब भी अच्छी रिटर्न आती है we end up boasting, but we don't compare it to the right measure. Now let's look at a story. There is a runner by the name Suresh. Suresh is a very hardworking runner and wants to win a competition against Mahesh. Suresh does his training and is able to finish a 100-meter dash in 14 seconds. Do you think this information is enough for Suresh to make sure that he's going to win the competition? To know whether he's going to win or not, he definitely wants to know in how much time Mahesh is going to finish it. If Mahesh is going to complete his race in 13 seconds, Suresh has to work harder. The same goes for your investments. If you're making return and not comparing it to the benchmark, the story is incomplete. In this video, we're going to talk about things to look for while measuring your performance compared to benchmark. So what is a benchmark? Benchmark is a yardstick through which you're trying to measure or compare your performance to. Like for example, the common benchmarks that we all know are Nifty 50, Sensex, Nifty 150, Nifty 200, Nifty 500. In this video, we're going to take an example of a statement and show you how you can measure your performance and compare it to the benchmark. If you're able to see the screen, in this statement, we're able to see that all the investments are divided between various categories. Broadly, they are divided between 3 categories, which are debt, equity, and hybrid. Under debt, there are various other categories. In equities, again, there are various other categories like ELSS, FlexiCap, Focused, Mid Cap, Small Cap, etc. In the hybrid also, there are 2 categories which are arbitrage and balance advantage. So if you look at the statement, what I'm trying to say is it can be divided, your funds and in portfolio can be divided between various types of securities, and each securities will have its own characteristics. On the screen, when you're checking it out, you're able to see that there are 2 types of returns being shown: absolute return and CAGR. I'm showing you a portfolio, and here it is pretty much evident that about 48% of the portfolio is into equities, 32% of the portfolio is into fixed income, and 18% into cash and liquid products. So when you look at a portfolio like this, there are multiple categories of funds, multiple types of securities involved. So you need to compare performances across various products. So I'll just show you how the portfolio has done. So this is the portfolio return. In 1 year, the return is 1.8%. In 3 years, it's 11%. 5 year, it is 9.5%. In 10 year, it is 12%. Here is a comparison with benchmark, which subsequently has given about 9.35% in 3 years, 8.7% in 5 years, 9.86% in 10 years. So you see the return alpha that is generated by a portfolio is almost about 2 to 2.5% on a long-term basis. By looking at this data, you're at least trying to make a judgment that whether you have outperformed the benchmark or not. But one question generally arises, Krishna, when there are so many securities involved, there is fixed income, there is debt, there is cash, there is equities, how do you make a comparison. So that's where I'm going to show you how the benchmark gets constructed. So when you look at this portfolio, the benchmark comprises of 48% equity, 32% of debt, and 18% of liquid. So this is in line with the portfolio allocation that we have seen in the past. In this video, we're going to talk about 5 things that you should look in your portfolio to measure its performance compared to a benchmark. The first thing is absolute return or CAGR. When you look at the statement on the screen, there are 2 types of returns, right? Absolute return and CAGR. Most of the times when we compare our returns, we only look at absolute returns. So what are absolute returns? Absolute returns only talk about your returns from point A to point B. It misses out a very important point, which is time period. Like for example, most of us hear our ancestors saying, मैंने 15 गुना बना लिया अपनी प्रॉपर्टी में, 10 गुना बना लिया प्रॉपर्टी में, right? But they fail to see in how much time. In 20 years, if you 15x your money, that's 15% return. In 20 years, if you 10x your money, that is 12% return. So it's very important to look at the holding period return. In the statement below, if you look at, let me just scroll down to the bottom line, you see the average holding period of the portfolio is about 470 days. That means in 470 days, the portfolio has generated an absolute return of 15.15%, which is equivalent to making an annual return of 9.05%. So always compare CAGR if your holding period has been greater than 1 year, and look at absolute return if the holding period is less than 1 year. The second point is category-wise comparisons. In general, all the investment avenues can be divided between 3 broad categories. Point number 1 is equities, point number 2 is fixed income or debt, point number 3 is hybrid, which is a combination of debt and equity. If you look at the screen, I'm showing you few of the categories for equities, debt and hybrid, right? On the equities, when you look at large cap, it has its own benchmark, which is S&P 100. When you look at large and mid cap, it has its different benchmark, which is BSE Large Mid Cap Total Return Index. Flexi cap, multi cap, mid cap, they all have their own indices. When we talk about debt, the debt also has its own indices. Like when you talk about long duration, the index is the VR bond index. When you talk about medium term fund, it has a different index given by CRISIL. So what I'm trying to say is, when you're managing portfolio across categories, like in the statement which we were talking about, the whole money was divided between various categories like credit risk, low duration, medium term, short term, large and mid cap, mid cap. Now each funds will have its own benchmark. So it's very evident that we have to compare which category is beating its benchmark and which category isn't. If you're looking at the screen, I'm showing you one of the portfolios which has 48% into equities, 32% into fixed income and 18% into cash. That means it's divided between 3 different areas. Now to compare the performance, we do a custom benchmark. For equities, we have a different benchmark. For fixed income, we have a different benchmark. For cash, we have a different benchmark. Based on the proportion of equity, cash and fixed income, we have to construct this benchmark. You look at this custom benchmark, you see MSCI India IMI growth USD is 48%, which is equivalent to the equity in the benchmark. CCIL all sovereign TR INR is a debt index, which is equivalent to the fixed income in the portfolio. Then there is CCIL liquidity weight T-bill TR INR, which is cash oriented portfolio, which is equivalent to 18% cash in the portfolio. When you compare the performance, you can have a look over here that in the 1 year, 3 year, 5 year and 10 year periods, the benchmark has given about 9.35%, 8.7%, 9.86%, whereas the portfolio has managed to give 11.36%, 9.54% and 12.41%. In all the periods, the portfolio was able to beat the benchmark by somewhere between 2 to 2.5%. So this is how you compare the performance between benchmark and your own portfolio. The third point is ratios. There are a lot of ratios which gives you a comparison of your performance on a risk adjusted basis with benchmarks. We have done an extensive video on 5 ratios which you can check out here. If you're looking at the screen, I'm showing you ratios for the same portfolio we discussed, right? You look at standard deviation, mean, Sharpe ratio, alpha and beta, right? So you look at standard deviation, it is a measure of volatility. In the 3 years, the benchmark had a volatility of 10.43%, whereas the portfolio managed to give it 10.30%. So this was less volatile. The same data is evident for 5 years as well as for 10 years. In 10 years, you see the data is almost equivalent, right? You talk about Sharpe ratio. Sharpe ratio is a risk adjusted return. It talks about how much your fund manager is giving you extra return compared to the risk he's been taking. So you see benchmark Sharpe ratio is about 0.52%, whereas for that portfolio it has been 0.72%. In the sense, compared to benchmark, the Sharpe ratio of the portfolio is much better. The same trend continues for the 5 years as well as for the 10 years. Alpha, on the other end, talks about the value generation that the fund manager is creating compared to the overall market. You see, in the 3 year, the fund manager is able to create 2.13% alpha, 1% alpha on a 5-year basis, and 2.43% or alpha on a 10-year basis. The beta is a measure of risk. It talks about sensitivity compared to overall market. That means how much your portfolio is growing or falling compared to overall market. A beta of greater than 1 is considered more sensitive. A beta of less than 1 is considered less sensitive, right? So here the portfolio was having a beta of about 0.94% consistently. That means on an average is equivalent to the market risk. The fourth pointer is stock intersection. Stock intersection talks about the common holdings between various funds that you own. When we talk to a lot of investors, we realize that we keep buying funds and stocks. There is an NFO, we keep buying it. There is an IPO, we keep buying it. Over a period of time, our portfolio becomes a plethora of just investment products. But we fail to realize that true diversification is not about owning highest number of securities, but owning different set of securities, right? So if you're able to see the screen, this report talks about how different or how unique your funds are. You see, the portfolio that we were discussing about had Infosys as a holding, but Infosys was common in these many funds. State Bank of India was common in these many funds. Axis Bank was common in these many funds. So what happens? The portfolio is not truly diversified. To have a truly diversified portfolio, you have to make sure that there are limited number of securities overlapping between portfolios. The fifth and the last comparison pointer is risk reward scatter plot. We've all known that risk and reward goes hand in hand. If you're taking extra risk, it should be compensated with extra return. If you're able to see the screen, I'm showing you a risk reward scatter plot for the portfolio we've been discussing. You see, the x-axis talks about the risk in the portfolio. The y-axis talks about the reward. When you put forth all the securities on this axis, x-axis and y-axis, the whole portfolio is divided between 4 quadrants. Quadrant number 1, low risk, high reward. Quadrant number 2, high risk, high reward. Quadrant number 3, high risk, low reward. Quadrant number 4, low risk, low reward. Generally, as an investor, you always look for portfolios which are either low risk, high reward or high risk, high reward, right? So the portfolio had number of securities. They are being fared out between low risk, low reward and high risk, high reward. So when you compare all the holdings together, the black dot talks about the overall portfolio, whereas the black square is talking about the benchmark. So what conclusion are we making over here? that the black dot, which is the portfolio, is falling in low risk, high reward quadrant, which is the most preferred quadrant. This means the portfolio is either taking lesser risk or equal risk compared to the benchmark and is delivering better return than the benchmark. So make sure when you compare your portfolio, your overall performance falls in either of these quadrants. So to measure your performance and make sure that you're outperforming the benchmark, there are 5 things that you should look for. Your return, absolute returns and CAGR, your category-wise returns, so you make apple-to-apple comparison, your ratios, so that you make sure that you're making enough money and enough returns on a risk-adjusted basis. Number 4 is the stock intersection, so that you believe and you make sure that you're making true diversification. Number 5 is the risk-reward scatter plot to make sure that you fall in low-risk, high-reward quadrant. Thank you for watching this video. Like, share and subscribe to our channel for more interesting videos.